Hey guys, it's that Dividend guy coming at you with another Robinhood portfolio update. Happy Thursday. Hopefully everybody had a GGD, a great green day in the market. You know, I always wish the best for my viewers and subscribers. Speaking of subscribers, we just hit like 450, which is insane. If you haven't subscribed yet, go ahead and hit that red subscribe button and the bell icon so you don't miss any updates. I post a Robinhood portfolio update Monday through Friday. I think consistency is key here on YouTube, and I love the growth that we've seen, and I'm super excited every time my views go up, anytime I get a new subscriber. It just makes me feel phenomenal. So thank you guys so much for all the support through the comments on Instagram and showing your support by subscribing. It really does make a huge difference, and it makes it so much easier to keep up this momentum. So if you guys enjoy consistency here on YouTube, make sure you hit the subscribe button. With that being said, guys, let's dive into the portfolio today. We're going to go over the overall portfolio, the individual holdings and how they're performing. Then we're going to look at the watch list, whether or not I would buy. Maybe I'll go into a little bit more why I'm looking at some of those companies, specifically the ones I'm looking at buying. And then we're going to look at my growth stocks as well. So as for today, we are up about $160. For the week, we're down 1,100, almost 12. For the month, we're down about a grand. 3 month mark, we're down about 2 grand. For the year, we're down about 2 grand. All time, we are down about $780, down about 3.82%. Not worried about it though. Fluctuation in the market is part of the game, and in fact, for a dividend investor, this is exactly what you want. So you want to see a lot of red, and I know that's kind of hard to grasp. When the stock price goes down, the dividend yield goes up, which means you lock in a higher yield. It's like buying an iPhone for $1,000. You go into the store the next day, it's 980, but they're selling for eBay at 1,000. So you know if you buy that undervalue, you have that $1,000 locked in, but you buy it for 980 and you go and you sell it for $20 more. So that's kind of like what dividend yield is like. You lock in that yield, except you don't sell it, it pays you instead. So you can put it on Amazon and just say that it sits and the price goes up. You bid it, right? That's like what a dividend is. So that's what we're doing here. We're locking in good yields, and when I see that overall the portfolio's been down, that means that there are deals within my portfolio. As you guys can see, the buying power is at about 1640. That was from extra dividends that I accrued at the end of this month. But I'm just gonna let that sit in there. It does accrue a little bit of interest, nothing super impactful, but I'll leave it in there and let it help my next month's dividend. So let's take a look at the overall portfolio, starting with my favorite um, REIT in Realty Income, Quality Dividend Aristocrat. This is one that I always want to buy, and I wish I could right now, but financially I can't do it. But I have 15 shares, $871 of market value. Average cost is $45.38. 4.43% of the portfolio is in Realty Income, and we're up $190.80, up 28% on Realty Income. Great stock too. Look at that price. Our average cost is $45.38, so it is above my average cost, but currently it's not at a bad price. I mean, it's sitting at about $60 a share, and even here I have about $24 of upside in the stock. I just got it at a ridiculously good price. So I this is one of those that I know my golden rule is to not increase my average cost, but this one, as long as it's below like $65, I would buy it. So this is one of the rare occasions that I would buy a stock, even though it would increase my average cost. Next, we have a Dividend King in Altria Group. We have 149 shares, $5,500 of market value. Average cost is $43.61. 28% of the portfolio is in Altria. We're down about a grand overall here, 15.27%. We are down, but again, it's a Dividend King. Their payout ratio is exactly where they want it. I know it's kind of a declining business. They have to increase the prices of their products to kind of keep that the profitability where it's at. I'm not worried about the industry. They've diversified enough. They have multiple businesses and subsidiaries within the company, real estate included, that make me more comfortable holding the stock. And it is a big position, and it's down pretty far, but I would not put any more money into it. I know there was a comment yesterday on one of my older videos talking about how I'm under diversified. I 100% agree, but there is a reason for that, guys. The reason you see Altria, AT&T, and ExxonMobil being my biggest holdings are because as I've been investing, my rule is I always put $1,000 or whatever. I think it's going to be 500 from here on out, just because I'm saving more money. But I always put money into my lowest stock, as in, like, if Altria is at 35, right, and Coca-Cola is at 54, I'm going to put money into Altria. That's really what it's about, is I attack the stock that has the lowest price, because as I said earlier, that locks in a good yield. So right now, Altria is at 36, and I have about $15 of upside. Coca-Cola is at 47, and it's at 60. So right now, Coca-Cola would actually be a better buy. Speaking of Coca-Cola, it's the next stock on the list. A Dividend King here. We have 20 shares. That's going to go up. Coca-Cola is one of my most favorite stocks. I'm a Buffett fan, and I love the product lineup for Coca-Cola. About $950 of market value. Average cost is 51.26. 4.8% of the portfolios in Coca-Cola. Down about $70. A little bit more than 6.5% there. We are down. Not going to bother me. Coca-Cola is one of my favorite stocks. I will forever buy it as long as they own Coca-Cola, as long as they own the brand, which they will forever. And they have the product lineup that I buy. Like I buy Coca-Cola every time I go to the store. And one of my major rules for investing is buy what you love. I love Coca-Cola, so this is one of those that I will definitely add to. And this is one of those that it's my goal to um, buy more of. So I would never sell a stock. Like I said earlier, Altria, AT&T, and Exxon are over exposure, right? I have too much of that. Coca-Cola is one of those that I really do want to add, so my percentage of Altria goes down. So I'm never going to sell anything. I'm just going to buy more of something else, so that overall percentage in certain stocks goes down. Um, so like I said, I'm down, but I don't really care. It's Coca-Cola. I'll buy that for the rest of my life. Then we have FRT at 69. Dividend King here, quality REIT. We have one share, 69.31 is our market value. Average cost is 113.40. 0.35% of the portfolios in FRT, down 44.09, down about 40% on FRT. So out of the stocks that pay me this month, being Altria, Coca-Cola, and FRT is the best deal, which means that if I had the capital to allocate, this would be the stock that I would buy. I know Coca-Cola is what I call my goal stock. It's the one that I want to be dividend efficient, the fastest in, but I can't ignore a quality deal, and that's what FRT is, in my opinion, right now. So I would have to jump on this because it's at $69, and it's literally half of its price. It's down 50%, I think about 50% for the year. Let's take a look. Yeah, just about 50% for the year. So I would have to, like, look, if just to compare it, for the year, Coca-Cola is only down 10% and Altria is down 18, about 20%. So out of those, FRT is by far the biggest dip, and it pays the best dividend out of all of those. So it's quality, and it's a steal right now. So I'm kind of ticked I can't buy it. But that's the goal, guys. That's the rule, is to buy the biggest or the best paying dividend stock that's hit the hardest whenever I allocate funds. Next, we have Lowe's, a quality dividend king, one that kind of burned me, and I'll explain that. We have two shares, 320 of market value. Average cost is $100.86. 1.64% of the portfolio is in Lowe's. We're up about 120 bucks, up about 60%, and they're paying me a dividend of $1.20 on November 4th. So by the end of next week, Lowe's will be paying me. Here's why I say it burned me, guys, and this is an investing lesson for everybody, especially me. So it's okay to buy small portions of stocks, right? Just buy what you can afford, even if it's fractional shares. It really doesn't matter. It's about building long-term wealth. But one of the things that you learn is sometimes you should have bought more, right? So I didn't always do this allocation or this strategy where I bought the most down stock, right? I bought whatever I wanted to, whenever I wanted it, which is okay, but my strategy is more efficient, and it makes me dividend efficient and pays me more every single month. I didn't used to do that. So back when I was just throwing money around, I bought two shares of Lowe's because I had extra cash, and I learned it was a dividend king, and I liked it, and I loved the dividend growth rate and the CAGR and whatnot. So, and the payout ratio, it's a great company. But the problem was, look at my average cost there. It's $100.86. It's now at $160.75. So I wish I would have bought more. I think I bought this when I bought my biggest position in Coca-Cola, which I think was like 10 shares or something. So I bought that, and then this with the leftovers. But I wish I would have bought more. So the issue that we run into with this position specifically, guys, and it happened with AbbVie as well, it's so high now that my intrinsic value calculation for the stock is around 50%. So if it's at $180, I would say $90, which is about where I had it, but then a little bit lower than that. So I would try to go for like probably like an $85 range. So I even bought it when I felt like it was overpriced, but since it was only 2 shares, I didn't care. But quality companies rise, guys, and that's what happened here. And I probably will redetermine whether or not I want this position, specifically because it's so like it's grown so much since I bought it. I don't want the money to be trapped in there, but they did a really good 9% dividend increase for this year. So it's definitely quality. It's exactly what I want in my portfolio. It's just it's gained so much, like it's what happened with Target. It spiked so much that I felt the money was trapped, and if I reallocated it, it would make me more money, and I could get a profit off the top as well. Next, we have AT&T. This is my goal stock for this set of months. Below 30 is like a crazy steal. I have 126 shares, $3,300 of market value. Average cost is 29.68, so great cost on average opportunity there. 17% of the portfolio is in AT&T, down 377.95, down 10%, and a nice dividend of 65.52. So, guys, the story with AT&T and myself, as you can see, I'm going to go over the five-year chart here. So I started investing April 2018, right? So it got up to like 34, so I bought it down here somewhere, like in the 30-ish dollar range, right? That's where my first buy was. Then I bought more, and then when it got up to like 32, I'm like, it's overvalued, dropped back down, I bought it again, around 30. Then it spiked because I think it was called Elliott Partners, got on the board and they said that they were going to sell DirecTV and make the company more profitable. Then it spiked up to almost, I think it was close to $40. If it didn't hit it, it got very close. So for this whole, like, look at all this time. So from April till February 7th. So a pretty long, continuous no buy period for me for AT&T there due to my average cost. Then it just tanked in March, like everything else. It dropped down to 24, or excuse me, 28, and now it's down to 26. So this is the lowest I think it's been in 5 years, and I'm super ticked that I can't buy any. But I do have a lot of a big position in AT&T, and I will be adding to it specifically. I love AT&T, love the business. I love that somebody got in there that cares about the health of the business, and it should help, you know, help make the business more profitable by condensing it down and only keeping the most profitable portions of the business. Next, we have AbbVie. This is kind of the same deal as Lowe's. As you can see, it dropped like a rock below where I bought it. Oh, that's so sad. But I have AbbVie here, 60 shares, $4,800 of market value. Average cost is $72.22, which was a steal at the time. 24 about 25% of the portfolio is in AbbVie, up 508.64, up 11.74%. We have 70.80 coming in from AbbVie. So this is the same deal. But the thing is, guys, this position is so big now that it doesn't bother me. The problem that I have with Lowe's specifically is it's not that much money in the stock, right? So it doesn't generate that much. It only generates $1.20, right? AbbVie has nearly like almost $5,000 in there, and it pays me $70. That's almost my electric bill for this month. So AT&T and AbbVie already pay my internet and electric technically, which is crazy. But the problem is I'm not comfortable adding here, right? Well, right now it's probably okay, but like a month ago when it was at like 90 or whatever, I wasn't comfortable. But right now I'm probably okay because it would only boost it by like $6. But I would like it closer to my average cost of 72. So I might buy it at like 73 to 75, but this is still overvalued for me. But I just wanted to explain the difference. AbbVie has enough cash in there that it generates enough passive income that I don't get irritated when I can't buy it. It still benefits me to have that money allocated to AbbVie because it's such a good paying stock that I feel like I'm not missing out on anything. But if I bought AbbVie at 72 and it was like $200 in there and then it shoots up to 94 like I think it was like 94, right? Yeah, like $95 or $96 like it did, I would probably sell it off, take the profits, of the 3 to 5 shares that I had, like I should with Lowe's, or like I talked about doing with Lowe's, reallocate that to something that's undervalued like AT&T. See what I mean? So it's a different monster here with AbbVie. But I've had a lot of questions about if I think Lowe's is a money trap. I don't think it, for me, and I don't mean like a bad investment. I just mean, have I thought about reallocating Lowe's like I did target, 100%. But as long as the dividend increases are there, it's not the main focus of the portfolio right now for that set of months. AT&T is, and I want to wait it out with Lowe's. But I do love AbbVie. I think it's a phenomenal company. Next, we have PBCT, my bank pick, which got slammed, or it's been down for the year. Did pretty good today. I think I bought it around $11. We have 13 shares, $140 of market value. Average cost is $10.80. 0.7% of the portfolio is in PBCT. We're down 65 cents, down 0.46%. So they're a quality dividend aristocrat, and the reason I like that is because I'm pretty sure like banks like J.P. Morgan Chase, Wells Fargo cut it, but like J.P. Morgan Chase had a decent dividend history for like dividend growth history. I know Goldman Sachs had a decent one. Bank of America's had a decent one. So has U.S. Bank. The thing is, all those big banks have had a lot of regulation issue, as in like they've struggled. Like they didn't increase the dividends during the financial crisis. Not a lot of banks did, right? But they have since. But now with the cap that the Fed just put on, a lot of virus, a lot of banks have cut their dividend, which that's why I wanted PBCT so bad. And I want to thank Dividend Diplomats. I think I did yesterday too, but they brought this stock to my attention. Because I was burned by Wells Fargo. I didn't want to be in another bank. I just thought it was a waste. And PBCT has 25 years of dividend growth, and so it's cheap. Like it's kind of a value stock, but it's got that growth. So it's like the perfect world for me. I'm a intrinsic value investor. I'm a value investor that goes for dividend growth. It's kind of like a Warren Buffett method, because Buffett makes his money off dividends. He buys stocks like this, undervalued. Like he bought Coca-Cola at like $8.20, and that company has grown the dividend for like 56 years or 60, something like that. That's what this is. This is like that golden find. It's like the needle in the haystack, where it's cheap enough that you can allocate a lot of money towards it, and historically it'll pay you more. And it's one of those that's like set it and forget it. As long as they keep the money coming in, the dividends coming in, I don't really care. But it's cheap enough that I can really take advantage of the dividend, and it will help a lot. See what I mean? It's a lot easier to buy a $10 stock than it is an $80 stock. So it's smarter to buy PBCT or AT&T versus AbbVie because of how much more I can get for the amount of money I'm putting in. So, yeah, I love PBCT, and I'm happy that I picked that up. And I do also want to mention, I picked this up with Altria dividends. So my money that I worked for paid me dividends. So interest on my money is what dividend is, right? Is what a dividend is. They pay out because you hold shares. So the company, Altria, paid me, and I used that money that I was paid to buy PBCT. So I didn't put any money. I put money in for the dividend, but Altria paid for these, which is awesome. That's what the whole strategy is about. So it's just such a cool thing. Next, we have J&J and 36912. So next set of months, quality dividend king here. We have 2 shares. 273.02 is our market value. Average cost is 135.79. 1.4% of the portfolio is in J&J, and we're up 144, up 0.53% on J&J. 3M, we have 2 shares. Dividend king here. 316.96. 147.28 is our average cost. 1.61% of the portfolio is in 3M. We're up 22.41, 7.6%. And I do want to comment real quick. Sorry, I know this video is going to be longer because I've kind of been ranting more today, but I think it's fun though. But I've had, like I said earlier, I've had a lot of questions about being under diversified. Like, why don't you have more J&J? Why don't you have more 3M? I want more. The problem is, as I said earlier, they don't go down. They're quality. They rarely go down to a point that if it falls below my calculations, right? Like both of them are above my average cost, so neither one of them will be buys for me currently. That's the problem. And also, the other thing that I did, or that I've done as an investor, is I've looked at the efficiency for the stock. As in, if I put $10,000 in, say, ExxonMobil, I'm dividend efficient in it. And what that means is when it pays a dividend, I can reinvest it and buy another share. It takes like 12K or 15K because they're so expensive versus what they pay. So it takes a lot more to be dividend efficient in J&J and 3M than it does to be efficient in something like Walgreens or ExxonMobil. And that's really what I've been focused on. That's why those particular stocks in my portfolio have such a heavy allocation because I'm already dividend efficient in it. Where, like, I'm dividend efficient in Altria and AT&T, right? If that money, the same money that's in there, like the 5,000 and the 4,000 or whatever the dollar amount is, were put into these stocks, being J&J and 3M, they're quality dividend payers. They fit the portfolio. They're exactly what I want, but I wouldn't be dividend efficient. I would get paid less by 3M and J&J versus what Altria and AT&T pay me, and that's why I'm quote unquote under diversified, because I'm efficient in those stocks. The goal is to be efficient in everything, but that takes a lot more. And my thing is, I would much rather use 5K to be dividend efficient in something like Altria, and then use that dividend to buy something else that I like maybe an AbbVie or an AT&T, because the money's less. That's the only reason. Sorry, I know I talked about that earlier, but that's why I'm under diversified, because those stocks were the cheapest when I had the money to allocate, and so they were down the furthest. And not only that, they're more efficient. It takes less money in the stock to be more dividend efficient. Next, we got Walgreens at 33. Definite buy here. 6 shares, 201 for market value. Average cost is $39.92. 1% of the portfolio is in Walgreens, down about $40, which is crazy, down 16%. So that's insane. We're down we're down our average cost. That's kind of funny. So my average cost is 39, so I'm down a little bit here. Good cost down average opportunity on a soon to be dividend king. Next, we have ExxonMobil. This is definitely the biggest, the most slammed position, and this is the one I get asked about the most. I'm not worried about it. I know I probably say that every video, but I get questions literally about this daily. Dividend aristocrat. 84 shares, $2,700 of market value. Average cost is $53.20. 14% of the portfolio is in ExxonMobil. We're down $1,700, down 38% on ExxonMobil. And again, guys, this is the stock that was down the most. At $53.20, look at the 52-week high. At $53, I had $20 of upside. So I have $20 of upside on 84 shares. That's $1,600 where I'm at right now. That's insane. That's a $1,600 upside on $2,700. If I did that again, I would have like a $2,000 upside on $2,700. See what I mean? So, yes, it's down further, but I don't regret buying where I bought because it still works out. Like that, just because it dropped more doesn't mean I made a mistake. It just means I held longer and it's down further, so it makes sense for me to buy again. But yeah, guys, look at that. Look at that, $53, and its 52-week high is 70. So 8 times 2 is 16, right? So more than $1,600 I'm up on a $2,700 investment plus the dividend. So I'm up even more than that. That's crazy. So it's still a good dividend play, and it was still a great time to get in. It's just a better time now. So I don't regret buying Exxon. I have a $1,600 upside plus a $70 dividend every month that pays me on $2,700. That's a really good return, guys. It's just better right now because it's dropped further. Next, we have Aflac. Aflac, the duck. Quality dividend aristocrat here. I love the payout ratio. Love the business model. 1 share, 34.18 is our market value. Average cost is $35.75. 0.17% of the portfolio is in Aflac. We are down $1.57, down about 4.4%. This is just like I said with Coca-Cola. Aflac is my goal stock, but it's such a glaring deal to buy Exxon right now. I've got to do it. Look at this. So Aflac right now pays a 28-cent dividend. They're a dividend aristocrat. They're a phenomenal company, but ExxonMobil is just so much better. It pays 87 cents for $33. So it's a cheaper price to buy Exxon and a better dividend. So that's why I would buy Exxon instead of Aflac right now. Next, we're going to look at the watch list. We have Cisco at $55. Definite buy there. We have PepsiCo. I love them because of their Frito-Lay. They're so diversified within the business. I actually, as a stock, like them better than Coca-Cola. I'm just brand loyal. I love the snack foods and the cereals and just the all. I love the business. Even Warren Buffett admitted, which is he's a Coca-Cola king there. He always pulls for Coca-Cola. He even admitted in an interview that he wished that Coca-Cola would have bought Lay's instead of Pepsi, which is funny because he's not a Pepsi. He doesn't own PepsiCo, but he liked that acquisition so much he admitted he wished Coca-Cola did it, which that's why I would want to buy Coca-Cola. I own it and I love it, but that's why I want to buy Pepsi because of that diversification. Because Coca-Cola lacks that, but I think the reason Pepsi did that was because they knew they weren't going to beat Coca-Cola with Pepsi. I mean, Coca-Cola is the number one beverage company in the world. And since Pepsi was second place, I think they knew that they needed to diversify. And it was a good business move. I think that's why I like the stock more because they diversified. But at 132, it's just not enough upside for me to buy it. I would probably just buy a couple shares, something I could replicate just to get the position started. Kimberly Clark at 132. Uh, yeah, enough. There's enough upside. $28. I'd definitely be buying some Kimberly Clark right now if I had the cash. Colgate at 76. I know it's not enough upside at $80, 52-week high, but I can buy enough. Can buy like ten shares at $760 in a month, and it would be a great quality king to add to the portfolio. It fits. It's literally everything I want in a stock, and a price that I can afford. This is kind of like PBCT. They have such a good track record, and they make products I personally buy, which I hope you buy toothpaste. Um, everybody should buy toothpaste. But they have an array of products, ones that I use every single day. And like I said with Coca-Cola, you need to buy stuff that you believe in. Buy stocks. Excuse me, buy stocks that you purchase from every day because it's like you're paying yourself when you buy those, right? Next, we have Procter and Gamble. Same deal with Colgate. It's more expensive and there's not as much upside, but this is one of those quality companies that I want to own. So definitely want some Procter and Gamble in the portfolio. Next, my shining star for this set of months on the watch list, SX Property Trust at less than $200, 52-week highs 330. So you have $200, 220 bucks, more than $220 of upside in the stock. That's crazy. 220 right now in SX Property Trust. I would be sell. I'm almost at the point where I'm going to sell a kidney to buy this stock. It's crazy. And they're a dividend aristocrat. So here's the thing: not only are they priced really low right now. I know $197 isn't cheap, right? But I'm saying compared to its 52-week high, it's a steal right now compared to what it's been at. Compared to the high, it's a steal for the price. It's a steal for the dividend, and it's a steal for the growth of that dividend as well. And it's real estate. You can't go wrong with that, and it's apartment buildings. So millennials don't want to buy houses; they want to live in apartments. So it checks all my boxes, right? It's real estate, which I want more exposure to. I feel like that's where my generation is heading, is more apartment complexes versus homes, because we can't afford them, and you do get the consistency, and you get the appreciation in the stock when you buy it right now. So definitely wish I could be buying some SX Property Trust. Next, we have Black Hills. This is my utility for the portfolio, close to king status since they're 2 years away. At 57, definitely want to be buying it here with $30 of upside. Not as crazy as SX Property Trust, but it's still great. Next, we have McDonald's at 213. At 231, we have more than $15 of upside, which means that my stingy ass will be buying some McDonald's because I want that. I want the company. I go there all the time. I eat there like it's the only restaurant open. And look at that. Dang, they really had a lot of volatility today. But yeah, definitely will be buying me some Mickey D's. I love the Golden Arches, and I watch The Founder like every week. I love that movie with Michael Keaton about how McDonald's was like stolen. Love that. Next, we have Apple at 112. I would have bought it at 120, so definitely buying it here. 110. Definitely will be buying it. I got $27 of upside on Apple stock, and I love Apple. It's my favorite company on the entire stock market. You can't really go wrong with Tim Cook. He is just a slam dunk home run hitter for a CEO. He convinced Buffett to get into tech, which is something Buffett had sworn off for years. He praised the airlines before he praised tech, and he bought like I think it's 5.9% of Apple or something like that. Definitely want some Apple in the portfolio. I love that they pay a small dividend, but they have so much cash on hand they could buy anything that they want. They are literally the most expensive or most profitable or highest valued company in the world. They're literally the most expensive brand in the world. So love Apple stock. Can't really find enough reasons to buy it. So that originally was my goal for November. So I'm starting my job here soon, and I want to build up my 6 month emergency fund. But I might allocate some birthday money to Apple. So I should be getting paid like on the 20th of November or whatever before the month's up. I'm gonna be buying some Apple stock for my birthday. Next, we have Disney, which I love it just as much as Apple. It's in my probably my top five. It's not a dividend paying stock, so when I say my top five, I know I always say it's like Coca-Cola, then AT&T, but Procter and Gamble. I've had a couple, I've switched the list every once in a while, but Disney is definitely one of my top five favorite companies. Period. Like everybody's loved Disney since they were born, pretty much. And I don't think that's going to change. I think they're a powerhouse. They have content with Disney Plus. They're smashing that. They're smashing the streaming wars. And I'm a Disney kid. It's in my DNA. So I'm such a big fan. But at 120, at 153, you have $33 of upside in the stock. I look for 15, so Disney is definitely a buy for me. But yeah, guys, I'm definitely going to be buying some Apple stock here. Within probably the next, I think it's 3 weeks. I start on Monday, so I gotta wait 2 weeks out until I'm paid. So that would put it to like the third week, I think, of November. But that's gonna be my birthday is on Wednesday for next week. But I will be buying Apple stock for November. I literally have to. It's my favorite company, and it belongs in my portfolio. So, anyways, guys, I know that was a little bit of a longer video. Sorry, I know I ranted a couple times about certain companies and why I've been doing stuff. But it's really important to me that you guys know why I'm doing what I'm doing. I'm transparent. And some of the videos, I think the videos should start getting a little bit longer because I do really enjoy that. I like, talking about comments and specifically singling out stocks on why I bought them in the videos. I think that's really important. Especially to look back and see if I was an idiot or something. But with that being said, guys, thank you so much for watching. Remember to hit the red subscribe button, and when you do, hit the bell notification so you don't miss any updates. I post Monday through Friday on my portfolio, and I just love investing. So leave a comment down below if you want to critique the portfolio, ask any questions, stuff like that. I will reply. I reply to every single comment as quickly as I can. And I'll see you tomorrow with another dividend investing video. Take care, guys.